Welcome to ETF.com University, where we demystify the world of ETFs. My name is Dave Nottig, Managing Director here at ETF.com. Today we're going to discuss one of the most exciting part of ETFs. That's right, taxes. Be prepared for real edge-of-the-seat stuff here, folks. All kidding aside, taxation is actually an incredibly important part of your investing experience, and it's important when you think about ETFs as well. You wouldn't buy a fund without understanding its expense ratio or what it owns, so why wouldn't you take a moment to understand what you're going to be paying in April? So remember back to our first session when we discussed some of the core benefits of ETFs. We had low cost, tax efficiency, intraday trading, access, continual improvement. You'll notice that taxes were right up there on top of the list. Well, why is that? Well, as we covered earlier in Creation and Redemption, most ETFs have an option about what tax lot they pass back out to authorized participants anytime there's a redemption. And they pick the lots with the highest embedded gains, so over time, they're constantly raising the cost basis of the ETF's portfolio. And that makes it very unlikely that when the fund does have something to sell because of a rebalance or a change in the index, or because it's actively managed, there probably won't be any reportable gain at all. But not all ETFs and all ETF structures are created equal. Depending on what the fund invests in and the structure it used to come to market, there can be some differences. So let's start with the base case. The majority of ETFs are really just mutual funds under the hood, whether they're technically unit investment trusts like the original ETF SPY, or whether they're just open-ended funds. Really, all stock and bond ETFs have very familiar tax treatment if you're already an investor. And that's really just like any other mutual fund. You pay a long-term capital gains rate of 20% when you sell if you've held it for more than a year. You can receive either qualified dividends, which are taxed just like capital gains, or non-qualified dividends, which are just taxed like ordinary income. But while over 2,000 ETFs have this very simple, easy to understand tax treatment, there are a few edge cases that are really worth pointing out. There are actually 4 cases where your taxes might be a little different than what I just said, and let's walk through each one. First, there are precious metals ETFs like the Spider Gold Trust, GLD. These ETFs, of which there are a few dozen now, just own the metal that's sitting in a vault somewhere. And the IRS has decided that owning gold or silver in an ETF is pretty much just like owning it in bars or coins sitting in your basement. So they tax your ETFs the same way as if you're a collector. And that collectability tax is a little different. Any short-term gains, well, they're just ordinary income, but any long-term gains, you get taxed at 28%, which is a lot higher than you might expect for, say, a regular old equity ETF. And that's just the price of investing in gold. Second, there are other commodity ETFs like, say, the United States Oil Fund, USO. Those kinds of funds are technically commodities pools, and the IRS treats that as if you were owning those underlying futures contracts on oil or whatever else. These funds are actually marked to market at the end of the year, which effectively taxes you as if you'd sold them. That kind of tax treatment also gives you a different kind of form. It's a K-1 partnership form, and that'll tell you whether you have a taxable gain, whether you sold or not. And those embedded gains are taxed every year at a 60-40 blended combination of your long-term and short-term tax rates, which works out to a maximum of about 27.8%. Now, that's a good deal if you're holding for a short period of time, but it's not a great deal if you're holding for a longer period of time. And yet another word of caution, there's a new breed of no K1 commodity ETFs that use some clever construction to retain the more normal equity tax-like treatment. So you do need to do a little bit of research ahead of time if you're investing in commodities. Many popular strategies tracking alternative exposures like, say, volatility aren't actually funds at all, they're exchange-traded notes. The good news is, from a tax perspective, that's pretty much irrelevant because with the narrow exception of a few currency exchange-traded notes, they're all just treated like regular old funds, 20% long-term capital gains rate. And last, there are a handful of ETFs, really I think 6 or 7, tracking master limited partnerships that actually get taxed like corporations, meaning that some of the taxes get paid by the fund itself, and the distributions that you get may actually be in the form of a tax-free return of capital or regular income or some combination of the above. If that all sounds confusing, remember that of the nearly 2,300 ETFs in the US, over 90% have the same traditional tax treatment as the rest of your stocks and bonds and mutual funds. And if you're ever confused, we highlight each fund's specific tax treatment in the efficiency section of every ETF fund page at ETF.com. So while that's the maybe slightly confusing landscape, let's dig in for just a second on how little most ETF investors really need to worry about any of this. Like I said in the beginning, because of creation redemption, most ETFs never pay any capital gains out at all. And that makes your taxes extremely simple, and you're very much in control. You'll pay taxes on any dividends you actually get or any income you actually receive, but then you'll just pay capital gains when you sell, so it's in your hands. You can think of this creation and redemption process as kind of a washing machine for capital gains, which cleans the funds up and defers any potential taxes until you, the investor, actually do something. And I think that's a lot more tax fair. So here's the scoreboard for, say, the 2018 tax year. Of the nearly 2,300 funds in the market, just these handful made any capital gains distributions at all. And of those that did, those distributions were extremely small. Whether a fund has a gain to distribute will depend on a few factors, but the biggest one is just how much internal churn a given strategy has. A momentum fund, for instance, that rebalances every single month will have to do a lot of buying and selling, and it might not be able to wash away all those gains if there aren't any redemptions. A big passively managed equity fund, however, might only have to make a rebalance trade once a year, and all that time throughout that year, they're constantly resetting their basis higher and higher with every creation and redemption. That's why when you look at some of the big ETF issuers with very simple product lines, you'll find that they've really never had to make a capital gain distribution at all. So let's sum this up. The vast majority of ETFs really never make any capital gains distributions, and that means your tax treatment is super simple. You pay when you receive something or when you sell something, and you're in control. And while there are a handful of cases where that's different, it's pretty easy to find out. Just head to ETF.com/whatever ticker you like and check out the tax treatment under the efficiency tab. I hope this has been helpful, and I hope you'll join us for the rest of the series.